Hey guys, so it's the first episode of the stream that we decided to do on a regular basis with Nitin, and we talk about different stuff. About there would be some regular sections like our view, our performance, what positions did we buy, what did we sell, maybe some more stuff, how we analyze companies because I think it's important to see uh, it should be an educational part in this whole thing. And so, yes, this is like a pilot first version, and where we try a few things and see whether it makes sense or not. Maybe Nitin, maybe let's start from the whole thing, who we are. Why do we do this? Because I think it's an important part as an introductory to understand who we are and what are we doing and why. Maybe you can start and then I continue.
Yeah, yeah, for sure. So I am within my day job right now is I'm a tax accountant here in Canada, tax auditor, I guess, for the government. But most importantly for the investing side, so I used to be a value investor not so long ago, like about 5, 6 years ago, right after COVID. It was a pretty good time for almost all investors, but like for value investors specifically, because there was a lot of deep
But
value companies.
when you say
Yeah.
value investor, you mean what exactly? So you were looking at the like a balance sheet and searching for nets or a low price to book or what? Because just important for
Yes.
context because there are different types of these investors who are investing differently. And probably a lot of us were starting from really this value stuff and low book value
Yeah.
and cash more than the market cap and so on. It's just how did it whole? What do you mean by
That
value?
Yeah, that's a really good point. So basically, like the value for me, it's not like deep value investing or like bankruptcy investing or something, not like that. For me, it was mostly like so I bought like some IT companies back in India. At that time, they were selling at book value with growing revenues at like 15, 20%, something like that. And they were selling for 1.8 times book, 1.6 times book, and their buildings, which were majority of the book value, were in like larger cities, which they bought like 30, 40 years ago. And I know the buildings itself probably just had like so it's net, but also the revenues were growing. So it wasn't only like a stagnant company that's not going to grow revenues, and that was like a perfect time to buy these kind of companies. Yeah, so like bought there's a company called Cyient in Limited in India, which
How's
ended
it
up
called?
doing Cyient. So it's Cyent.
Uh-huh.
I believe I started buying it at like 180 rupees back in 2020 and ended up going to like 1200, 1300 rupees or something like that. I didn't hold through it, obviously, like got out at like 400, 500 rupees, which was a big win at that time. And then had another company called Nava Bharat, and it's changed to, I think, Nava Limited now, NAVA. For them, they had a big, I believe they had a subsidiary in Mozambique, which was worth like almost 200 rupees per share, and the company was selling for 48 rupees. So there was a lot of debt related to that, and there was some geopolitical issues. But like the debt was pretty much like isolated to that subsidiary, and the Indian company was worth 200 rupees itself in book value. And then manganese was their main product, and manganese prices were going up. So I was like, okay, these are going to do well, and they were cash flow generating. They were net income positive. Everything was so things like this, where there was a certainty of cash flows, and it was like net. A lot of things had to come together for that. And
Hmm.
yeah, worked out great. But then I think after 2021, when you see like crypto going up, everything going up, you're like, well, like all these value companies were already priced very quickly. Like there was like this 8 to 9 month window where everything went up, and then after that, nothing was moving as such. And then in the Indian market as well, like what happened was there's a lot of retail participants that jumped in. So it
Like
was very
everywhere, I
hard.
think. I think everyone,
Yes,
people were
exactly.
stuck at home and
That's
trading
true.
like crazy. I mean, that's also when my story started because I have pretty similar. But finish, yes,
Yeah.
first.
Yeah. So the ARB with like those kind of companies kind of went away because like anything that was a little bit mispriced was just like getting re-rated quickly. So you didn't have enough time. So then I just started to like kind of think what I need to do. And 2021 wasn't that great for me because I got like whipsawed a lot when the June crash happened. But then it still had like pretty good returns in 2020. But then the market corrected and things like that, and I had some personal health issues and stuff. So I was kind of not too much into the market itself in 2022 was pretty much bedridden for majority of the year. 2023 came back, and I was still kind of thinking about value investing and things were not working out as I thought. Yeah, so basically then started looking into social arc, came across some of the stuff that Chris Camillo
Chris
had in
Camillo,
20.
the famous Chris
Yeah,
Camillo.
exactly. In 2024, so the latter half of 2024 was really really good for me. I think I almost had like 110, 120% returns in the last 5, 6 months of 2024, and then I was like, oh, this is pretty good. So then 2025 is pretty much a lot of social up trades. Some of them worked out. I did have a really good year, but towards the end of the year, I started kind of realizing that some of these names take a lot of time to get priced in. So the reason was I would like most likely be right. I'd still be wrong, like 20-30% of the times. But I was my hit rate was pretty good. But it was just that the time that it took for these to get realized, these trends to get realized into price, was longer than I thought it would take. And due to like supply chain issues or things like that, where you would see the trend is going up, but the company wouldn't have the supply to meet that demand. So then, like it'll take like 3 to 6 to 9 months sometimes for that trend to actually play out. So then I started getting into more, the thematic trading and stuff, where like the themes were hot, the charts were good, the numbers were good, so they get multiple re-rated and stuff. So 2025 latter half was a lot of that, and it worked out really well until October. And if everybody remembers, if they were in high beta names, October November was pretty, was pretty like intense. And we had a
Yeah.
I had a decent drawdown in November. I think it was almost like 30%, and that kind of broke me because like it was the first time I actually was like I think I got very carried away with it because when I looked at it, my portfolio had a lot of like you call them like bad companies, just thematically relevant, but that's about
Shitcoins.
it.
They are
Shit
called
codes.
shitcoins.
I don't know if I can use the words exactly. So they were basically shit codes, and I was like extended myself too much, and the portfolio like dropped significantly. I think I had like almost a 30% drawdown at that time, and then I was like, okay, I need to like kind of regroup here and
Yes.
hone in my strategy, and then kind of spent a lot of time in November just like learning how to technically trade. So I did spend some time learning how to like technically like how to like read a chart technically and like how to like kind of make that work. But then after that drop, I was like, okay, I think I need to like hone the skill even further. So then kind of got into that, and then like that has helped me significantly build systems a little bit around myself. Have given weightings based on what if I'm looking at a specific thematic trade or like social art trade, how can I weight it, how quickly I can realize the returns and things like that. So that has been a process for the last 4 or 5 months, and the first 6 months have been the best first 6 months I've had so far in my like investing journey. So it is working. It's just a discipline. Sometimes I do get carried away by the shit goes again. And then on Monday I'll buy something, and I'm like on Wednesday I'm like I don't want this, and I'll just sell. So
Yeah,
I
I
still
have the same. I totally. It's so weird because when people sometimes probably most of Fintwit when they look at us and how I mean if even they don't even know how much we trade probably because
yeah,
I'm
yeah.
the same. I buy something, yeah, this will double, and then in 3 days I say no, sorry, I sell it.
What was
And
I
and I
thinking?
yeah, exactly. And I think on Fintuit there is a lot of guys who are certainly not the same, and they kind of buy very. They look at the stock very. They build a huge thesis. I mean, and then hold it for I don't know. Several months, but yeah,
Yeah,
I mean, we're the same in this sense because I also change thoughts very very quickly, especially
yeah.
because at the time when you buy, you have a certain information, you collect it, but then you start your enormous chat with Claude, and then you ask and feed him all the news that you just read. You get more context, you get more. Things to reconsider, and then suddenly you realize it's probably not that good of a trade, and then obviously you sell. And I mean, I've seen a lot of I know a lot of people that are having this problem with selling underperforming stuff, and because they, I mean, it's also in the Thinking Fast and Slow book, because people have this bias that they avoid losses, so they think if you didn't sell it, then it's not a loss. And I think that's what's different with both of us, that we are quickly, maybe sometimes too quickly, but I don't have the problem with that because I know what you're talking about this drawdown of 30%. This is very painful. And I also had the few of those painful drawdowns, and specifically because I owned mostly shitcoins in the end. I mean, and I'm so tired of all these volatile companies like Vera Bradley or Ferragamo that goes 20% bill kind of lower, and then next week it recovers and goes up. I just don't. I'm probably too old for this shit. So so yeah.
Yeah, I know
Yes,
for sure. So yeah, you can go ahead now. I'm actually yeah, please.
good. Yeah, I'm actually unemployed guy. I'm 43, and I was working basically for one boutique asset manager for more than 20 years. First as an analyst, then as a head of research, and then also a partner. And then slowly but surely kind of realized that it's not exactly what I want to do, and not about it's not about that the field is wrong, but the setup is probably wrong, and I want to do something independently. And gladly I had enough money to really try new things, and just managing my own money and see and have a few projects. But I also like you. I mean, you were a value guy. I'm from the beginning was. I mean, I was value guy a long time ago, but mostly I was really in this social ARP, alternative data, I call this thing, and especially in 2020 when all the stocks came down massively, and in principle you could buy anything, and but
Yeah.
I was looking at all these Google Trends data, Wikipedia, and see the bikes are going through the roof, or the headsets for gaming are going through the roof, or yeah, you name it. Invisalign was my biggest win in 2020 was probably Invisalign, because I had both a stock and an option and options, and then I just remember very this day when our sons were born. We went to the doctor, and and Invisalign reported the results, and I came out of the doctor with the babies, and then I look at my screen. Hey, I just earned, yeah, a nice amount of money, and it's an unforgettable feeling that you really placed a bet, and it went your direction, and you earned quite some money. So that's a feeling that you cannot compare it. So yeah, in 2020, I really had a fabulous year, and trading all these social ARP and consumers companies. Then in 21, it already started to look a little bit differently, and everyone was. It was clear it's already a bubble, and you probably also remember these times that everything was going to the moon,
Yes.
and it certainly did not end very well. And I mean, I was feeling this was coming, and I somehow started to buy these software as a service stocks, which I thought makes a lot of sense. These brightest minds from hedge fund industry are betting on those. Then that I should also go there, and yeah, it's actually I lost quite some money, and then basically stopped trading end of 21. And it's also, I remember very vividly that I went to Switzerland, and there was a guy who is in his 60s, and he said, yeah, you should better, it's so good, you should I mean, take some chips off the table, and it was very wise thing to do. And then in 22 we had quite a drawdown. I was basically not doing anything for the big part of 22, and yeah, but I also vividly remember this first big drawdown, and it was
Yes.
not very nice and painful. So yeah,
Yeah.
uh,
I was
but
like, so I think my early experiences kind of got a little. I should have shared that because I'm 28. So like back in 2019, 2020, I was like only like 21, 22 at that point, and I didn't know any better. So like, reading all the books from like, I read all the letters from Warren Buffett and like reading all the Benjamin Franklin books and stuff like that. Like my investing journey has been pretty much like self-taught in a way, like transitioning from that value side to like more thematic trading where like, you're betting on multiple expansion. So I guess I should give you that backdrop as well because I missed that initially. So sorry.
Yeah, it's no problem. But basically, I think we're very similar in our track records and
Yes.
how we came out of this social arc alternative data thing and really got probably tired of that and decided that it should be a little bit more than the shit costs that are volatile like hell. And I mean, it's actually great because also this year, you also don't post a lot about tech stocks, right?
I don't post about them because I just feel like I'm not adding anything
Yeah,
else.
yeah, yeah.
So that's already available. So that's why like recently I've been quite like my account hasn't been that active as such. I'm still trading like probably more than ever, but it's just that I don't think that I can add anything that people don't know about because this is not my background. So that's why I don't feel like posting as such because I'm just adding to the noise it's not needed type of thing. So yeah.
Yeah, because also this year I'm the same. I don't post about my tech stocks, and this year a big part of it also came from latent value, which we also both know, which is
Yes.
a brilliant guy and investor. And
Yes, no doubt.
hey, hi, Nipun, if you're watching us. Yeah, but I think more and more we should, I think, post also about our positions and diversify because I'm also a little bit tired of this because there are no secular compounders in retail, which I posted for a while now, and there are a few like Games Workshop, but
Yes.
mostly these are secular themes like off price or luxury experience, which we talk
Yes.
about a little bit later. So yeah,
Cool.
that's probably the end of the first part, right?
Yes.
Let's make a break here. Hey, so the first big section called Big Picture. What happened during the this week? The main thing that we're discussing FinTwit that we thought are important, and obviously a few things happened. One is Warsh statement, first statement, after which the markets were not really very cheerful, let's say, because they realized that probably there would be more tightening than was expected. I mean, it was expected, I think, before, but really afterwards, what happened is now we're pricing one hike at least, and but then this whole thing reversed basically right the next day, and due to Iran deal and the Trump basically, yeah. I have a lot of questions about this deal and whether you can really say that this is very good one, but
Yeah.
obviously markets like that the at least this saga is somewhere
Straight.
close to the end, and
Yeah.
so I don't know what do you want to say about that? How do you feel? What was important to say in this context?
Yeah, I think as you said, we probably don't want to get too political and stuff. I think the
Yes.
political side of this is, I think, kind of known to anyone who's objective as to what was done before, what is happening now. Completely makes no sense in that case. But like, I think the fact that they'll have $300 billion to invest probably, I think, leads to the defense spending kind of remaining elevated for a long period of time. because the threat is not going to go away. It's probably going to get worse. So we can see like I think the charts for the most defense stocks look pretty bad. So I think there's going to be a phase where they kind of what do you call it, like reset a little bit. But I think the headline risk with that Middle East saga maybe is gone for a little bit, but I think it'll probably come back very sooner than most people think. In the sense that even if the deal goes through, I think they'll probably in the next year or two they'll probably hear something again, because not all parties are happy with this whole thing. The Middle Eastern countries obviously want this thing to be done because a lot of they probably suffer most economically, but I could see them rearming and things like that. So I think that probably changes that dynamic forever. In terms of the wash situation, I feel like that one, as you said, like the fact that I think 9 of the 19 people on the board said that they could
Yes.
see one interest rate hike by the end of this year. I think that sort of was a big eye opener for a lot of people. But I also personally, this is just anecdotal, and this doesn't represent the entire world. But from what I've seen, I don't get that sticker shock that I was getting back in 2021 when I used to go to the grocery store or used to buy anything. So I think this inflation headline number is very much inflated by oil prices and where the oil prices were during those readings last month and the month prior. So I think like inflation probably is there still, and I'm sorry if I'm offending anyone about this. There might still be inflation. I don't personally think that inflation situation is as bad as 4% if we compare things how they were in 2020 and 2021. So I think this is a headline risk number. So if the deal actually goes through, oil prices have already come down significantly. So I think those numbers will start to cycle. The other thing I will say is Warsh said that he monitors the stock market very closely. So I think that is
Yes.
something to watch out for, which is also I
Yes.
think interesting. And
I think
he's very much
yes.
yeah. Sorry, go ahead.
Yeah. No.
Oh, yeah, and I was just saying, like, in terms of like the previous things that he said also is like he believes in the AI productivity boom. And if the headline numbers does start to, I think, kind of pull back a little bit, I think we will see hopefully the stance of those people on the board kind of changing. And just I don't like how they do stuff. Back in 2021, they were too late. And this time, I think they were too late in cutting as well. I think the situation was pretty bad, and they could have made it better by cutting early. So I think those people are not as, again, I don't want to like comment on some people, but they're not competent enough at their job, and they're very backward looking instead of forward looking. So I think the approach, hopefully, when next time he speaks, because he said there'll be less meetings as well, so we don't know when. I think we probably know when he's meet. Maybe I should check, but I think there's going to be less meetings. But I think whenever the next meeting is, the stance might change because the headline number by then might have changed significantly because oil prices are slated to come down even further. So if the deal sticks, I think the oil prices could really help the inflation headline number to come down. And I also know like last year there was talks about him. He was basically saying the way the numbers are taken for calculation of inflation are not accurate either. There's a very small sample size that's tested, and it's a lot of like manual phone calling and figuring out what are the rents and all these things instead of actually using market data, which is more accurate. So I think if that also, I think that's something to watch out for as well. If that changes, and if the way they take data changes, then I think the rate of the inflation will probably massively change as well because the way it's reported. So I think that's something there too, and we know that this guy is watching the stock market very closely. So I think that could also, just like they used to say, is a Fed put. I think this is going to be a wash put to some extent, where if the market conditions do get very bad, there's going to be someone who's apparently watching it very closely, and maybe I think that might give some respite to a lot of people. And I think the more this guy speaks and the more inflation comes down, which hopefully it should, I think we should have that. I do have thoughts about how the like last quarter plays out, but for now, I think we're probably. I don't think we're kind of like going down right away as such, if that makes sense.
I mean, it's quite important to say that basically the next day, of course, there was a deal, and
Yes.
but a lot of retail stocks were leasing. I mean, the semis, of course, and but also the retail stocks. And I think this
Yes.
focus on the stock market is very important to understand where the stocks are going. And also, if you look at the fear and greed index, we're not very in the euphoria
Yes.
phase. And I think
Yes.
um, again, some places look a little bit stretched just because of the massive gains in the semis that were done, but they're also backed by fundamentals. And I really hate those charts when people compare dot-com bubble with the situation that we have now. I mean, you can, I mean, the valuations are different. The I think this AI boom has very tangible results already, and will have more. Of course, we
100%.
might. I mean, again, if we look at these charts with LLM token pricing, obviously there would be bumps on this road, but I think it's very, very clear path where we're going. And the only probably problematic issue that I see is that really a lot of funding will be required to fund this whole thing, and that's why the hyperscaler stocks diverged from the semis, but and I'm not specifically bullish really on hyperscalers either, because Microsoft, I think, is in deep trouble now. Google with the guys leaving, basically two guys, one left, Montrezl left to OpenAI, and then the jumper left to where did he leave? To Anthropic. And I think that's also shows a little bit that Google having a lot of problems, and Meta is anyways. I mean, I really am very, very negative on this company. I posted several times, though I mean, for different reasons. But I think when you look at what Mark Zuckerberg is doing, I mean, he has a huge ego, a lot of ambitions, but you can pour in as many billions as you want, but it doesn't lead anywhere. And obviously, someone has to fund the whole thing. And I'm pretty sure that a lot of retail that invested in the private credit linked to this funding end up somewhere with the losses, but overall I think no one is really arguing that AI is a big thing, and it's just no one knows how much this thing worth now, and everyone is just trying to not to miss the next big companies, and there is a lot of FOMO, and I mean, for me also, as I also was in the semi stocks, but I somehow have no idea where this momentum will end, and then it's very hard to jump back again. And when you talk about this change to 800 volt infrastructure, that's obviously there are a few plays that I also have on my watch list, but difficult. Now it's a bit difficult moment, but obviously you have to play it very carefully and not jump too fast, because I also now see there is a lot of doomerism in FinTwit, especially from the guys that missed the whole semi cycle, and they're so pissed that they try to say, it's all bullshit. I mean, when we discussed these memory stocks. It's a very cyclical. Forget about it. It's bullshit. And now the Micron, SanDisk are just going through the roof. I'm not saying that it's that you have to jump in now, but still there's a lot of
SanDisk was like the biggest miss for me, because I was long in at $45 in August last year, and then I just I talked to a few people, and I thought who were smarter than me, and they just said that no, this is cyclical, and I kind of sold my shares. I had 200 shares. It wasn't a huge amount of shares, but those 200 shares would have been worth a house in Canada at the moment. So, but that was that. And then I also add something about
with oil expert.
Yes.
Expert told, we'll have 100, 200 oil, and then suddenly everyone realized, the world after COVID became a very resilient place, and the Chinese just stopped consuming the oil above 100 and saved basically the whole world from collapse, and because they built so much inventory. So the experts again, it's I also like to quote this Poland asset management, which is a growth asset manager that was similar to my firm, and they lost
Yeah.
like a 50% from the top in 21. And these experts, they're experts in the past,
Uh-huh.
and but now the world looks so much different that these experts are not really experts, and you once in a
I
while
agree.
have to listen to your gut feeling. But sorry, I
Yes.
disturbed you.
Yeah, no, 100%. Like I agree with that, and I think that's one thing that I've kind of started to learn about myself as well. That I overestimate other people and underestimate myself.
Yes,
So that's
you
something that I have to
do
like
hundred
reconcile.
percent.
Yes. Yeah. So I gotta start doing that a little bit. I'm just trying to like start building that self confidence in myself that okay, sometimes my takes are not as bad as I think they are. So that's something that I'm kind of like working on as well. And I will also mention something about LLM token prices. I think that whole thing about doomerism, as you said, is there. I think the fact is that the LLM token prices are going down because of two reasons, according to me. One is there's a lot of capacity coming online. So there's a lot of efficiency gains with like within the data center from what I've read in terms of like, as you said, power semis with the 800 volt DC, the efficiency of those like the efficiency goes up by almost 13-14% if you do actually use power semis. I think instead of like the or like GaN and gallium nitride and silicon carbide instead of like just using traditional silicon. So that's part of it. So you can actually like extract more tokens out of the same infrastructure. So I think that's a big part. So, and if as more capacity comes online, there'll be more tokens coming online. And if like larger picture, I was looking at what the token prices were back in 2023, and if you just compare the 2023 prices from now, they've gone down 90%, and they're just going to keep on going down. So I think the token price, looking in isolation, and it's quite interesting because that index that you're seeing on everywhere on X goes from December 2025. It doesn't show you a 3-year, 4-year, 5-year picture. So I think that's pretty important. And the other thing I'd also mention with the token prices is that even if token prices are going down, it's because of the weighting of the open source models is increasing. That doesn't mean that the absolute usage for the closed source models is going down. So like say
Yes,
if we start at like 90% closed source, 10% open source, if the absolute usage grows still, which is still growing, if the closed source mix shifts from 90% to 85% and open source shifts from 10% to 15%, token prices are going to go down because the weighting between the closed source pricing and the open source pricing is so much that due to the mix shift, you're seeing those token prices coming down. So I think there's been a lot of bad takes that I'm seeing on X where people are like, oh, like, this is kind of peaking or things like that. It's just that there's more tokens per
no way.
wattage. Yeah, so that's people are implying that. So like it's either those two things. It's like either the wattage, the tokens per wattage is increasing, so there's more tokens. So Jevons paradox is like at complete play again here. Jevons paradox, like again, you use it more. I have not seen someone who's like people like stopped using more, and like even like small businesses and stuff like that. Because when I'm doing my day job, I see this that there's almost like all of them have Anthropic memberships for their staff and stuff like that. So that type of adoption we haven't seen very like and across the board as well. So I think that this, as you said, like 2020 was a completely different beast as compared to now. That's the one thing, and the other thing is the percentage of open source is going to increase. That's just the
Yes,
way it works. I think DocuSign. So I try to listen to at least like 40-50 calls every week, basically from different companies, what they're saying and stuff like that, all across the stock, all across the stack. And they were just saying that there's this thing about people shifting their workflows to specific models for specific tasks. So I think
yes,
it's more that you don't want to do like a basic task using a model which is going to be 10x more expensive or 20x more expensive. So you're trying to optimize your workflow for those specific different LLMs. So that does it, it's just it's a good thing for the market as a whole, because not like one or two companies wouldn't have 100% of the share. It'll be like, okay, what do you want? Okay, I want a burrito, for example. Then you go to a specific model. Okay, I want rice with some like curry or something. Then you go to a specific model. So it's like people are optimizing their workflows for specific models. So instead of like people thinking that the costs are going down, it's over, like token prices are going down, it's over type of thing. That's not the case. It's just being weighed down by the mix, which is now shifting a little bit towards open source models, and that is going to happen because the pricing is just insane. And we've seen so many people, like companies, come out and say that our whole IT budget for the whole year is blown up in 3 months or something. So that's actually a positive in a way. So that's something I think people are kind of missing in this whole token prices going down
Yeah,
situation.
absolutely. Because I don't know how about you, but I was in the beginning, I was using a lot of Claude and also the API. And then at one point they just shut me down, and that they said, yeah, you did not follow our rules, blah blah blah. We just we close your account, which
Oh
was
wow.
certainly not the case. They probably had a lack of capacity and
Right.
just shut down the clients that are probably not that important or whatever, for whatever reasons. And then
Right.
I switched to Gemini, which started to doing relatively well. They had this notebook LM. They had a lot of, the video generation was good for Google, some other stuff. And then, but then at some point I also switched from Gemini because it's really bad, and I use Gemini mostly for the simple tasks, daily tasks, and that are not really relevant. And the majority of my workloads are now, of course, Claude, which is now the main source, but also for research, deep research, I use ChatGPT, OpenAI, and so these are now my two main ones. But I also see, you see how Anthropic released the Fable, and now I also reposted the tweet from OpenRouter, that they said that the panel of a few models is basically as good as the Fable Anthropic model, and
Wow.
this I think is a major thing, that you have a few models, and every model has its own strength, and when you combine them, then you get much better results. And these with the local LLMs, I think that also makes really a lot of sense, because all the corporates generally they have a bunch of information that they can use to make these models work much better with much better results. Because, for example, you cannot reproduce the same quality of data in LLM relative to when you have your own data that you use. The very obvious case here is Notebook LM. When you feed it your own data and then you build something on top, then obviously it's much better than you just use the general LLM. So I think we will
Right.
see a lot of again, it's shifting a little bit from cloud to on-prem again due to these reasons.
Yes.
I was also just researching recently about this whole storage issue, because one of the companies that I have currently is NetApp, and they're exactly in display. They're not too expensive and not too exposed to this whole topic, but still they produce the storage, and I think storage would be important. And they said, unlike many others that seen the pent-up demand that was pulled forward, NetApp said it's not the case for them. They see that really a part of workloads will be on-prem. So basically, you have a few local machines and a few local servers that is basically running on the proprietary data, and that's why I think also software layer. Software is a bit special. Everyone is so pissed that software is not performing. Although there are some companies that performing. I can talk for myself. I bought Samsara, which is IoT platform for tracking, for industrial, for basically for any asset fleet tracking and managing. And they kind of had very nice breakout, but then they came down quite a bit again. But there are still companies in the cybersecurity mostly that are doing
Yes.
relatively well. And really
Yes.
this usage-based cybersecurity, and not like
Right.
a contract-based. So I think that's also why Snowflake is doing relatively well, because this is mostly also managing the data from different sources, and also
Right.
yeah, but I share completely your worldview, and yeah.
That's awesome.
Good. Then let's maybe talk about the performance. But again, performance, I don't want to, I hate to say about my performance figures. When I made this post about my equity desk, I wrote that every time I post something online about my performance, immediately I go down. And it's exactly
Same.
like this. I didn't lose much, but I was like up a lot. Not like
Yeah.
yours performance, but still I came down a bit due to realigning a little bit my portfolio, because I want to make it more systematic. And this is what I
Right.
lacked, and I'm so tired of all, again, as I told in the first part, I'm tired of these consumer shit costs that are, it's just it's just not worth it. I mean, when I look at the performance of
Yes.
Vera Bradley, the stock doubled. I made a nice money. Vera Bradley is my best
Yes.
performer this year, but oh my god, this chart is just, it's not worth it. I mean, there is another a guy in Fins with Clark Square Capital,
Yes.
Armando, who is also in this trade, and I posted him that how I exited kind of step by step, and then when I was out of the stock, I also wrote him, yeah, I was also a bit worried about this whole consumer spending, because some companies like Zoomies, which I also followed and played, they said that there was very clear slowdown in sales, and Zoomies is very similar in a way, because they're also in malls, and like Vera Bradley, and yeah, and it's not premium luxury or whatever, and exposed to not high end. So
Yes.
yes, I don't want to say anything about performance. You just say that what are the main winners and main losers this year, and important to say something. What did you learn, and how did it go? A little bit the color and insights. How did it go? And yeah.
Yeah, for sure. So for me, I guess I could kind of give you like a little bit of a seasonal view, sort of, or like a monthly view.
Yeah.
So January was really good for me. January, I was up, I think I was almost 30% in January. I was very much into defense stocks at that time. So basically what I've done is, like, since whatever happened in November, as I just shared, in October, November, it was really bad. I'm trying to go like more exposed towards specific themes for which I like the charts, and they generally work out. So far, they've worked out great, so I don't want to jinx it. January was really good. I was almost up 30% in defense stocks. Got carried away, went for a vacation. And I think I was like, again, it's just like ego that starts to come in with you. You're like, oh no, I kind of know what I'm doing. The market wasn't like that great, and I still had a really good month. So kind of like, then instead of like, I took some profits, but generally I'm very quick with taking profits. This time, like, I'm gonna try to like hang on to these profits, and I gave back a lot of it because of that in the first week of February. I think it was like up like at one point like only like 9% or something like that. And then when I saw the Nasdaq chart, just didn't like the way it looked. And I just basically went super into kind of massively into the retail stocks. So companies like Jones Soda was a big position for me. NSGM, Motorsport Games. I was tweeting about all of these companies as well, and I was like almost 50% in cash at that time. In February and March, and that was a big realization for me, because like the Motorsport Games company, it's, I think, again, it was like I thought there was a social arb portion to it, and then there's also what do you call it, like social arb as well as value, because like the price, the market cap doesn't make sense, and I knew about the risk of
Are you
their,
sure?
they have a
Are you
joint
sure
venture.
it doesn't make sense?
What do you mean?
No, no. I mean,
I'll just
I
I'll
just
just
can.
share I'll just share more.
I
I,
Yes, please.
yes. No, for sure. So they had a joint venture with like the WEC. That's the company that owns the rights to the company, and I knew that they were going to have a great set of numbers, which they did as well. But the thing was that in the fine print, there, it did mention that once they recoup all the expenses that have gone into the game, they have to give away 50% of the profits to them. And based on the historic returns that I saw, based on what they've kind of done in the past, I thought that moment won't come until the end of this year. But that moment came way earlier than I had expected, honestly. And like I still was early, so like I was able to still make money on it and still have a little bit of a position because I still feel that the IP that they have is worth quite a bit, and it's just like, and I just believe in the CEO as well because with his past track record. But like it was almost up to like 10 to 12%, but I've got it down to 2 to 3%, and I was losing a lot of opportunity cost because of that name. So that's why I kind of like ended up trimming that. And then trimmed a lot of my other shitcos in terms of shitco retail companies because they were just not performing. Like Jones Soda is probably another example where the numbers have been astronomically, like they've gone up quite a bit. The guidance keeps on going up, but they're just not listed on a Nasdaq exchange or on NYSE. So they're only on OTC as well as on a pretty low tier what do you call it, exchange in Canada. So that stock also hasn't done anything, although the numbers look so good. And I think when they do uplist, I think this will change. But again, it was just opportunity cost at that point, and that was one of the reasons again why I was like, this is not great. So then went into space stocks quite aggressively in April. I had almost all of the whole basket. 2x RKLB, 2x ASES, yeah. I had Voyager, I had Firefly, I had a Redwire, so I had like kind of like split my bets and was like massively in the space names just as a lead up to the SpaceX IPO because I thought that's probably gonna do well. And I was cutting right into that ASTS blast that happened. ASTS was my only remaining position, a little bit 2x ASTS. I was almost up like 120, 130% on it. That morning, I think it opened like 20% lower, and I was like, I'm out of this. It was 2 weeks before the SpaceX IPO, and I think that was a pretty lucky trim in terms of not getting too greedy again and just like cutting off whatever I made. And then was in the CPU trade in April because that was the thematic that was starting to like pick up. Everybody was talking about agentic AI, and so bought some. I didn't buy AMD, but bought some ARM and Intel. Late though, because I sold way too early. I had a lot of Intel back in January, but I sold when I saw Nasdaq looking the way it was. So that was mid curve thinking. I just thought too much about it and ended up selling my Intel position, which I shouldn't have done. But then I bought back, and it's been decent. And then a lot of power semis. So a stock called POWI, Power Integrations, has been really good for me. A little bit of Wolfspeed, a little bit of Navitas because those balance sheets aren't great, but there's very limited exposure when it comes to these companies. And then I actually bought a lot of Take-Two options, Take-Two leaps last month because the pricing just like there was so many catalysts like kind of coming up. The CEO. I actually want to talk about Take-Two as well as like one of my stocks that I want to talk to you about and share with the audience. So that was that, and then it's been great so far. And as you said, that whenever I share my performance, with my spouse or like when I take a screenshot or something, I incredibly have a drawdown the very next week. So as you said, don't want to share too much of the performance and stuff like that, I guess.
I just seen it so much that because obviously you want to share when you feel
Yes.
great and then your performance is great. But
Yes.
it's very much coincides with also the top because the stock market is cyclical and you cannot always win, and because
Yes.
exactly when you win, then you become driven by your ego and you think you're the greatest and you know everything going, and it's
Yes.
if I talk about my performance, it was also a very good year, and as I said, and I don't post about my tech stocks, and two of my tech stock exposure were from latent value, which drove quite performance, which is Planoptic and Hymax. But I also had another one which I picked up myself, which is IPG Photonics, which is like a laser stuff, but very volatile. I assume that at one point people thought that it's also an optics play and drove it down because everyone is now in the FinTwit obsessed with optics and who is exposed with optics, and everyone is following Serenity and subscribed to Serenity, and I think it's great. I think Serenity is the, if we compare now and 2021 with this how's it called, Kitty, the guy with
Roaring Kitty?
GameStop. Yes,
Roaring
yes.
Kitty,
I mean,
yes.
Serenity is a clear upgrade. So
That's
to
true.
Roaring Kitty, and because I think a lot of performance, latest performance was driven also by the amount of following he has, but still he's a absolutely brilliant guy, and but a lot of his plays were also not his initially, and many people discovered the same plays
Yes.
before, and this you should remember. And there are a bunch of guys that are just, again, very smart people, and I mean, with AI, with LLMs, how you can analyze things and how you can basically discover anything. If you have the natural curiosity and you're willing to learn, I think it's the greatest time that you to use it also to earn some money in the stock market, and it's really great time. And yeah, so some of my gains were driven by tech, of course, like anyone this year, and some, yes, Vera Bradley, as I mentioned, the famous shitco, and also the if I talk about my losses, the one is certainly Ferragamo, that was volatile like hell, and in the end played out, but obviously I was out, but I don't care, honestly speaking. I stopped
Yes.
caring about these kind of things, because before, it was, I remember in 2020 I was also in the stock market, and then the whole COVID hit, and I was so afraid to sell my stocks, because I thought, hey, next day they will recover, or
Right.
sometimes people hold the company because they think the company will be acquired because it's so cheap, but in the end that never happens. And if really
No.
the mood is changing on the stock, you will see it. It will not happen immediately. I mean, it can be that stocks will open with a gap of 20%, but usually you first have stabilization, then you have relative strength, and you will know it better. But still, I see a lot of positions taken by guys from FinTwit are basically buy the dip. So
Yes.
you see a price somewhere in 21, like PayPal. PayPal in 21,
Yes.
that's this high, it dropped like massively, and now people think, yeah, now I buy it, and when it will recover to the same level, I will make a fortune. This is just not going to
Not how it
happen.
works.
Because, sorry, the
Yes.
conditions that we had in 21 will not happen again. And
In a lifetime.
anyway, the kind of the payments are a commodity business, and that's why everyone is like Fiserv or Adyen or whatever company you name
Yes.
it. They're all going down. But there are also
Yes.
in the other sectors like Lululemon. Michael Burry takes. I mean, he's also like one of us buying it, hoping that it will suddenly go up. This is not
Yes.
going to happen. Or the same software as a service stocks, CRM, Adobe. I mean, it's absolutely crazy, guys. If this sort of chart with a relative weakness in a few years, it will not reverse suddenly, and then the stock will shoot
Yes.
up and go up. I mean, there has
Yes.
to be a really clear catalyst, and there's just this catalyst is not there. It's just
Yes.
non-existent. And
I
I think
agree.
I see that a lot, that people are just sitting in those companies that are just fell a lot, and they hope to kind of that it will recover, but that usually
Yes.
this thing never happens.
I will say one thing. I think that's something maybe people don't consider enough, and it's taken long for me to realize this as well. The catalyst sometimes is just multiples. Like, so what happens is, like with software, it's certainty of cash flows. Like with the software, like before this whole AI thing happened, there was a certainty of cash flows with the softwares, with software companies, and that's why the multiples were that high. But now with all this uncertainty, those multiples have compressed.
Yes.
So if you can if you can just play that game alone, you can probably do it. And it took me some time to realize this as well, because sometimes I will find a thematic that's, like that has good charts, or has like something that I think can reprice higher just because it has more attention, and then it would just go higher, but I would not be involved, because I'm like, I don't see the revenue guide is only 2%, 3%, or something like that. You can probably do well even with companies that go from negative revenue growth, or like degrowth,
Yes.
to just like 1 or 2% revenue growth, just because there are specific,
Yes.
what do you call it? As you said, like IPG Photonics. I also looked at that company just from that lens a while back, and then I read into it a little bit more, and I'm like, this is actually not Photonics. This is something else. But like exactly like that. Like there's just like that way of thinking of like, okay, is there a catalyst? And that catalyst could just be that there's more eyeballs on that segment, or on that sector as a whole. So like I believe, this is just my personal opinion, I think as we go into the next election phase, I feel solar is going to be that segment to some extent, where right now it's probably not that apparent that, okay, where does this come from? And there's so much FUD in the sense that the 48.5x credits are going away. But I feel like there's a lot of other catalysts around battery storage, or like even just if we think AI is a multi-year tailwind, and if we do think, like just by probabilities, if we think that elections might lead to a change, there's going to be a change in the energy policy almost certainly. And that, I think, we're very early, because a lot of those stocks are like in the very early stages of the first stage, or like actually just starting to base for the second stage. So things like that, where if you can find a catalyst, the catalyst could just be multiple expansion, because there's more relevance. Like that could be political relevance around it, or like there's like a sovereign nature of that specific stock. Like last year, if I knew this way of thinking, I would have bought Centrus Energy, which is like a uranium enricher. Their revenue hasn't exploded as such, but it's just there was more thematic relevance to that sector and that stock, and that was the best stock in that sector to play, and you could have gotten a 10x potentially. So you don't really need to, like as Dimitri said, find plays that are down 80%, 90%, and you think that they can go back. There's a reason some of the times they might have overshot, and now they are like maybe undershot, but also this is a losing market, because there's so many competitors. Like as you said, Lightspeed, Finserv, Adyen. There's so many of these companies that can literally reduce your take rate, and these merchants that use these specific providers, they're not loyal to these companies. They're going to go find a company which has the least take rate, and that's just going to keep on repeating, and people are going to find ways to like reduce that take rate. So
payments are not rocket not
yes,
rocket
exactly. And technology over time should get cheaper. Anyways, so it just doesn't make sense, and that's yeah, exactly it. Like find sectors that are going, they have like a lot of eyeballs on them. Sometimes that does lead to revenue growth, like optics. Sometimes it doesn't lead to revenue growth. It's just other things around that sector that are going to lead to more thematic relevance, more eyeballs, which will lead to those stocks re-rating. Because there's a lot of the stocks, like drone stocks, last year, I believe 2024, there's not many listed drone stocks. So even those numbers were like still overvalued to some extent, but you could have still made money if that's your goal. If you just focused on what is thematically relevant and find the best player, because generally there's like a large cap which has decent exposure to that thematic, and they are the ones who are going to get most of the contracts. They're the ones who are going to get most of the revenue. So they could be a company that grows revenue 3, 4, 5%, but if 10, 15% of their revenue comes from that specific sector, that stock is going to massively re-rate. Like Kratos is a great example of this, from defense. So you're better off buying catalyst-driven, thematic-driven stocks than buying value stocks that are probably going to take for years to get acquired, something like a value unlock to happen and things like that of that course. So I'll try to keep it short, but that's my 2 cents on that.
Yes, but if I have to ask, how do you really, because for me it was
Yes.
always painful really to screen a lot of alternative data, and there was no systematic in everything I've done. And I spent the last 2 years probably just to create a system where, because some time ago with alternative data, I was going through alternative data and I was not looking at the price as such, but kind of thought that it's not relevant, but in the end, of
Yes.
course, it is relevant because if you're right, then sooner or later the price will also notice that.
Yes.
But now, I realize that really the price is very, very important pillar of the whole investments game.
Yes.
And then again, as an information about how the business is going, these are the earnings calls, because it's completely necessary to really understand what's going on, what the management is saying, what criticism analysts are bringing. So these are the pillars I look at. And how do you screen for ideas? How do you, because you said you listen to quite a lot of calls.
Yes.
And how do you choose the calls to listen to? How do you learn from these calls? How do you pick the companies that you think are the best positions from every topic? That's important, because I have I built a tool which is I kind of posted about and how I approach this. How do you do it?
Yeah, mine is a pretty manual process. So basically, I look for specific keywords. So like I have a membership to Fiscal AI. So what I do is like I listen to like the larger players first. So I listen to like the Nvidias, like all the larger other semi companies, like Google or like all these worlds, and I listen to like each and every time if they do like a interquarter call where they go on Bernstein and things like that, or like Evercore and things. So I'll keep an eye on whatever is like coming up in terms of like these investor conferences, and I'll just pick the companies that I like from those, and then listen to what these guys are saying, and then sometimes like just from listening to them, if I don't know what they're saying, I'll open an LLM. I'll keep on looking up what they mean, or what are they trying to say. And when you keep on doing that, there's like a secular you'll probably like after a few calls, like maybe 10-15 calls that week, if you listen to 3 or 4 large companies talking about the same thing, then it's like, okay, is this thing sort of important? So like for me, like optics is completely off the table. Like I don't at all look at optics stocks anymore, because I feel like those companies are just like very much like priced in, and everybody's like already kind of literally everybody knows about optics at the moment. So for me,
literally the
yeah.
whole FinTwit is in optics. It's just
Yes,
crazy.
exactly. Yes. Yeah, it's a super crowded trade. So like for me, like this is probably not the perfect way to play this, but from memory, I was not early enough, but like I was in Silicon Motion, the company SIMO, ticker symbol. They're gonna benefit from NAND. So the way I found those companies was basically listen to calls from Micron, from like SanDisk, who do like almost a call every month, almost like in some of these investor conferences. So they keep on saying, and then also like the WFE companies like KLAC, or like companies like this which provide the equipment for the fabrication facilities, and all of them are saying that a lot of these what do you call it, a lot of the companies that do DRAM supplies, so like they also do NAND as well, but a lot of those companies are shifting shifting their manufacturing capacities from NAND to DRAM. So that's the reason why Coexia and SanDisk have continued to go higher, because the number of suppliers for NAND is going to keep on reducing. Then I was like, okay, SanDisk and Coexia, everybody knows about them. What is another play in this market that no one else is talking about? So that led me to Silicon, I think it's SIMO, Silicon Motion. So what they do is they make NAND controllers. So when I listened to their calls, and they had other segments as well, and they're gaining market share, because what SanDisk used to do is SanDisk used to make these controllers before as well, but they're not making these controllers anymore, because just selling the raw NAND is more profitable than selling the controllers themselves. So they've completely abandoned this business, and you need flash, and they have a specific, what do you call them, a specific technology which allows them to make the best NAND, and like kind of like layer it. And the way these controllers work, you have to get them replaced almost every 9 to 10 months. So that's going to be recurring revenue forever, for not ever, but like until this thing doesn't go away. And then they have another segment, and they're gaining share in mobile as well, because no one else wants to work on this segment anymore. And I listened to a couple of calls that they had, and they said that you will see our earnings power when we report our next quarter. And they said this 2 or 3 times. So, and they already had like a blockbuster quarter last time, and just the way this reading about the company, reading about what they do, I'm like, well, there's a potential that they actually their guidance for next year is like potentially like to $10 to $12 of EPS, and potentially getting to 20 to 25 the year after. So that's also at like 8 to 10 times earnings if you look at 2028 potential EPS. So then I was like, okay, well, I should be actually in this. It has underperformed the other like large crowded memory names, but I'm also going. There's a chance when like a Serenity or like a larger a larger person, larger account finally finds it and tweets about it, and then we get the re-rating at that point. So I'd rather be in something like this where it's not a crowded trade yet. So
Yes.
you can kind of regain. So this is like one of the examples. So that's the thinking. And then the other thing, like from SanDisk, what I've kind of tried to do now, and based on that, that's how I decide how much I'm going to allocate to a specific stock or a specific sector. Is there any ASP increase possibility in that specific sector? So like for SanDisk, the largest thing for them was, and that is the reason why SanDisk has outperformed Micron, in my opinion, is because SanDisk can actually scale capacity faster than their peers, and that's the reason why they've outperformed. And the other thing about SanDisk also was that they could increase prices, and that's the reason why the likes of Western Digitals and Seagates and all these other companies have done so well, because it's almost a commoditized business in that sense. Also, it's not a great thing, but also it's a great thing when the commodity cycle is in your favor. So that's how I kind of look about it. Okay, is there any pricing power, and can they keep their costs in check? And what is the premium in terms of how many other competitors do they have in the market? So for me, that's where like all of this led to power semis for me, and that has been one of the reasons, one of the places where I've kind of concentrated a little bit of my portfolio last month or two. This because from what I've seen, there's only three players that are large enough in the US market, which are in this segment. So that's Navitas, Wolfspeed, and Power Integrations. And then the thing is, like, Power Integrations is a profitable company. They've always been profitable. They have products in in EVs, in mobile phones, and they have both GAN and SiC. I'm not smart enough to figure out if their product is better than the others, but just because of balance sheet execution in the past and the fact that they've said their revenue right now is about $400 to $450 million per year, and they're saying their SAM for this new segment is $1 billion by 2030. So that's the serviceable addressable market, and they have been saying that they can achieve that. And it's a company that's like not wildly overvalued just yet. And they're also saying that the automotive business, which is GAN and SiC, have applications in EV markets as well. So the automotive market is set to double this year. They've already said that this year. So this is a company where, again, there's not many competitors. They have a product that's in the market right now. They're already with NVIDIA. They are cash flow positive, the small market cap. There is some sort of pricing power because their products are the best, and like iPhone chargers and everything else, that's the reason why those chargers have gotten smaller, is because of their chips and stuff. So you kind of know, and they talk about it quite a bit already as well. And it's not like a large market cap or wildly overvalued, and they have some pricing power when it comes to those things, and clear path to like almost tripling their revenue in the next 4 years. So that was like where I think probably is where the optics bros are eventually going to go to. So that's like getting positioned early a little bit, and then the options are not that expensive if you go in early. So you can buy leaps for cheaper, and then you get the IV on those options as well if you are right eventually. So that's how generally I kind of think that's the workflow. So if everybody's talking about the same thing, power efficiency, so this multi-thematic exposure to power, like for power semis, because you have power efficiency gains, you have the 800 volt DC architecture, you get better liquid cooling. So you have all these various thematics that everybody talks about kind of integrating into these three stocks. So then that leads to more attention, and that leads to more pricing higher. It's like my thinking, I guess, if that makes sense.
I remembered the tweet today that I seen from Bessemer, and they said
Okay.
the tweet is like obviously written by AI because it's I mean you know the exact wording how AI is
Right.
written. And then they said, while everyone is talking about GPUs, the next level is what did they say? Storage, liquid cooling, and all this stuff. And everyone is like commenting, "Hey guys, this is like a topic for 2 or 3 years. What are you talking about? Are you crazy?"
So yeah,
Yeah.
exactly. So
It's
yeah.
just. Okay. What do we? Shall we talk some picks?
Yes, for sure.
Maybe I start because you were
Yes,
talking now.
a lot.
Yeah. This is good. I mean, there are few companies. I mean, I posted a lot about how terrible is consumer business and there is no pricing power and these are all shit costs, and because basically there are things that I just don't buy, and one of this is gaming. That's why I was smiling when you talked about
Yes,
the
it's similar.
motorsports
Fair enough.
games. It's just I hate this sector. I
Fair
was
enough.
in this sector in maybe this is how we started communicating with Life and Value, because he was in Square Enix. I was in Square Enix in 2019, and
Okay.
I don't even remember whether we made some money, probably, but not a lot for sure. And during the COVID, I also had this stock called Guillemot that was making the you probably
Stems.
know. Yes, exactly,
Yes, yeah.
the steering wheels, and but generally I was also making the post about content, uh, how everyone is into this topic and how difficult it is to make money, because there's so much diversity in the offering that it's very hard to differentiate, and really there is no pricing power. Everyone is doing content, and the only company that wins probably is the one who distributes, like Netflix, because mm, the if you're into gaming, then your games should really be relatively big, and because
Yes.
the budget for developing is this much, and if you're below, then you're just making a loss and you spend the
Yes.
whole your capacity for nothing. So every marginal copy sold is goes directly into your bottom line, and that's why I think CD Projekt did relatively well, because they have two franchises, big ones,
Right.
Cyberpunk and The Witcher, and
Right.
for them it was okay. But generally, it's a very tough business, and you should value your business only on I mean, again, there is no terminal value,
Next one.
and
Yes.
there is so much stuff like Minecraft, like Roblox, and all these recurring franchises that kids are
Mm,
spending so much time on.
true.
And plus Netflix, plus YouTube, plus all kind of TikTok, social media, and now we have additional competition for eyeballs from LLMs, because
Right.
obviously that's much better use of your time, but it still takes time to research certain things, to communicate, and it produces at least some value, unlike social media. But generally, I was saying that there are very few companies in consumer that really have pricing power and have potential, and these are,
For
as
sure.
I said, mostly thematic, like off price, that is doing well just because it's a secular gaining market share relative to the rest. That's why I don't
Mm-hmm.
buy apparel as such. Okay, I buy if it's really completely dirt cheap, like G3,
Right.
the company I owned, or something like Vera Bradley, which is not apparel, but still, it was dirt cheap, and
Right.
I seen how uh, how it can change its path, because I've seen the turnaround, and usually and there are few signals that you already see, but but there are few thematic things that I really like, that I post a lot, and one is longevity. I mean, I was in Technogym, in other things that I post about, and one of the companies that again reappeared on my radar is Peloton. And I was checking Peloton quite a while, like also you did, and
Yes.
I was not really convinced. And but now I see that it is stage two again, not very decisively. It can still drift lower,
Yes. Quite a lot.
that's
Yeah.
for sure. But I see that finally I see the leveraging. I see that the business they show the first revenue growth in a while, which is a very important pillar. They are still losing subscribers, no doubt about that. Its business has not stabilized yet, but I think, and next quarter it might be due to higher churn. The revenue growth will be negative again. But I think that's not. It's already priced in, and the upside is bigger just because this is one of the few brands in this whole fitness longevity stuff that it is like a platform with recurring revenue, which is, I think, very important. And if you look at the current valuation, they are now profitable again, although there is some stock-based compensation inside. But still, I think it's a really, really good platform to develop further. And how they are buying the Pilates startup, and Pilates is also one of the growth themes in their business, because they also have their own business. And again, the revenue is slightly above 3 billion, and the recurring part, which is I think 2/3, is really subscriptions. And this is a recurring business. This is the recurring cash flows that you can use for growth, and they came down with the cost massively. And I think in sports it's very important, energy behind, drive behind, really the people that are driving the fun part of this business. And I think that's why they were so successful, and that's why, for example, Apple, although they own the best distribution that is out there, there is no sparkle in it. There are no people that are driving this whole thing, which Peloton has. I'm wildly speculating that Apple would buy Peloton, but if Apple would really be in a position to buy any business, because Apple stated quite explicitly that health and fitness and longevity, this thing is very important for them.
Interesting. Okay.
Then the only company that they could scale fast would really be Peloton. And again, I'm not saying about that. I think they already showed the pricing power because they raised prices and churn did not increase. They are growing year over year. That might change next quarter due to higher churn, but still, that's already a sign. The debt came down massively, and they're profitable. And now they're even thinking about the acquisitions. So as soon as we have seen a little bit more stabilization in the subscriber numbers, the stock will run. And I think it's already preparing for this run. And they're probably just a minor catalyst needed because the chart is ready. So again, I started with smaller position, and I would be very open to sell it if I see something that contradicts my view. But I think there are not a lot of assets like this in the market in this space. And that's why I think the stock is interesting, and certainly I sold my Technogym position quite a while because the stock behaves quite differently. Although again, AI is a big topic for exercise because it improves the efficiency like everywhere else. And I think a lot of innovation will be happening in the hardware, fitness hardware things, because just it adapts how you train and what are the results that you're getting. And I think Technogym started with that. I don't know how much is marketing, how much is not, but certainly this would be something to use for marketing also. But so Peloton is certainly one of the companies that, I already bought it. I will watch it closely for addition. So this is, I don't know, you also have your thoughts, right?
Yeah, no, for sure. I actually was long back in 2024, Q4, I believe, and worked out great. So I think, as I said, earlier as per our conversation, what's his name? I forget. David Einhorn was very long back in 24, 25. Yes, that's right. And yeah, so I think his whole thesis was that it's probably going to get acquired. So the fact that you're saying this again, the chart looks ready, that actually could be something that's potentially there. And I think you're right about the Apple Fit is probably a great idea because it's a pretty much like a premium luxury brand. And if Apple was to put its hardware, software capabilities behind this company, I think it could probably do really well. And I do agree with you on the balance sheet front as well. It's and the chart actually the chart looks it's a perfect like what do you call it, like a chart that I look at. So this is a perfect setup for me, and the risk reward is really good here. If it loses, the $5, $10, $20 level decisively, then you're out. So you're potentially only like 10% drawdown, but like the upside could be phenomenal. So the risk reward here,
Yes.
just from a trading perspective as well, looks pretty amazing. I got to look into this more, and maybe I'll have something to share on the next episode of this because I do like the way this looks, and I have made money on the stock in the past, so I have a little bit of what do you call it, emotional connection, I guess.
Yeah,
So
yeah.
so that's the other thing.
Uh,
Yeah.
yes. Shall I also then mention the other my
Yes, please.
position that was doing good recently? It broke out,
Yes,
and this
please.
is Lindblad. Um, Lindblad. Why I'm interested in the stock is because again, due to this shift from stuff to experiences to something that is really scarce. Because if I look to the recent events with the Knicks games, people were paying
Yes.
like crazy amounts of money just to be there, just to experience this. All the
Yes.
longtime New Yorkers kind of were paying huge amounts of money just to be there. And I think
Hmm.
it's a lot what's going on. I think again the people are Ferrari is not signaling your status, but if you were sitting in the first rows of Nick's game, then it's something totally different. I mean, I also posted
Yes.
some stuff from I think Taylor Swift and then Paul Tudor Jones sitting behind her talking on the phone. That was quite some fun. But I think there are not a lot of assets that are in this business, and Viking in cruises is one. Unfortunately, I never had it, although it was performing phenomenal. I somehow I knew the name, but I had no idea about the business and how premium and top it is, because it's just like they created the perfect environment for the perfect audience, because this is 55 plus, very wealthy guys that have their money and have their time and are ready to pay any buck for entertainment, because there are no kids, there are no casinos on board, and the top destinations, top experiences, and they have a tons of pricing power, and pricing power is really mostly non-existent in the consumer business. So
Right.
when I saw Lindblad, it's pretty much the same. It's just maybe a little bit more specific, because these are cruises. I mean, it's much smaller, and also not that clean business, because
Hmm.
they have some debt. They're not profitable, but still, because they pay franchise licensing fees to National Geographic and to
Well,
WWF which are partners for them. So these are basically specialized cruises to Alaska, to Galapagos, to other places where the inventory is basically limited. There are very little opportunity to go to the Arctic Pole and spend time there, and there are certain windows that you should use. Or
okay.
also in the other spaces. I mean, National Geographic belongs to Disney, and National Geographic is the premium brand and the most well-known brand that is related uh, to discoveries, to geography, to experiencing wildlife, and I think this is what makes this company special. The it's the product is very scarce, and that also is shown in the rate per night that they're receiving. In 21, the rate per night was, okay, maybe it's the base is a bit low, but still, it was below 1,000, and now it's 1,600, so it basically increased 60%. And I think they have the agreement with National Geographic until 2040. Until this period, they have the collaboration with National Geographic, and they have to pay the royalty to use the brand. And they also use the network of experts that are going on these trips and talking about the what you see, and what is also important to know about Lindblad, these are not just cruise ships, these are also the land experiences. And there are a few brands that they acquired. They are already 36% of their revenue, and margin is even higher than the cruise ships, because they have to, obviously they don't have to pay royalty to National Geographic and WWF, and but obviously this is again the consumer business, and there are you don't there is a lot of competition for cultural tours that you're making, or the I don't know, luxury cycling brand they have, which is called Jevons. Obviously anyone can do it, and you don't have to invest. I mean, it's a totally different thing from National Geographic cruise ships tours. So, but still, I think the potential to build from there as a platform is really there, and there is not a lot of companies that are in this business, in this area. So I was probably a little bit late again with this one, but still I thought the industry is trending in the right direction, and it's one of the, I mean, Viking is one and Lindblad is the other one, and I don't see a lot of these type of businesses in the market right now, and most that are their competitors are anyways private, so they could as soon as they pay down the debt, they can also acquire someone, and yeah, so these are a little bit my positions that I have. Again, as I wanted to say that I'm trying to be more systematic, so I'm just once in a while I want to increase the number of positions, and I want to have a clear system how I enter position and how I exit position, because I want to be early, and this is one of the important parameters that I have on my screen. It should be an early stage 2 entry, and if the stock goes out of stage 2, I sell it, maybe not, at least not better immediately. I can re-enter afterwards, but I sometimes waited for a week or so. Sometimes I didn't and should have waited a week or so, because you know, with all these consumer companies, they drop and then the next week they recovered. Vera Bread was the same, Ferragamo was the same, some others that I have were the same, and I yeah, but
it's too much volatility.
Exactly, it's not worth it. So I want to also be exposed to several baskets, because you said you had few, basically the whole your portfolio in one basket, and I think this is not optimal, and you should not.
No, yeah, it was only like 20-25%.
Okay.
Yeah, at all times. At all times, yeah.
Okay, then I misunderstood, because this is also what I'm trying to do, is that I see a few baskets. Like recently I was into tracking. I mean, I have no idea about the tracking. I hate this business. I mean, it's one of the businesses that is clearly a commodity, but there are a few big players, and there was a regulation change that passed the responsibility for any accident from the company that did it to the broker that was used in the process. And this basically, before, it was a lot of companies with troubled, let's let's say, drivers that did something, and then they were working in a month. They were working for another company, and brokers were not guilty of anything that happened. And now that changed. So there was a huge event that served as a catalyst for the whole industry to reconsider how they operate, because everyone is now going to the bigger companies, and they have more obviously pricing power because of this, plus also industry is doing very well due to the AI boom and all this capacity expansion, data center build-outs and all this stuff. So I was in this trade, and it was a certain basket. Then I also tried to find other baskets, like luxury experience is another one. And now I also, another cluster is, let's say, storage, for example, NetApp, or yes. Again, software as a service was another cluster that I was looking at, and I even bought something, but sold very, very quickly. So I also try to find really those baskets and diversify into those. Yeah, so I'm trying to be systematic on the entry, on the exit, and diversification, because I'm really, really tired of these consumer businesses that are too volatile. Okay. Yeah, for sure. I'm done.
Yeah, I have three quick ones. The first one I had was Power Semis again. The name of the company is Silvaco. It's worked out well for me so far. It's the ticker symbol is SVCO. So they basically do testing. So for me, like the ones which are recent IPOs, a big criteria for me is they have to reclaim their VWAP IPO. IPO VWAP. So basically that's the initial public offering when it happened, and this one was a recent IPO in 2024. So it has to reclaim for me the VWAP from that is anchored from the IPO, and I got a perfect entry at around 980 because I was like, it had a surge past, and then it had a basically like a retest of that level. So I added quite a bit there, and it's been good so far, like 25-30% in like 3 or 4 weeks, I guess. So basically with this company, what they do is, as I said, like for SiC, like silicon carbide and with the gallium nitrate, like they, due to the amount of current that passes through those larger chips, because they can handle a lot of current, and that's the reason why they're why they're so important at this point. It leads to tears, and it leads to the chip itself like having issues, and then you have to optimize to make sure that you can have like all the criteria and all the components are perfect, so that the chip functions. So what Silvaco does is, it's a $400 million company. They have a specific software that is basically only to run simulations for testing of specific GaN and SiC chips. So, and they're the only ones who do this as of that I know. And another large company that is that's in the space, they're a European company called Infineon. The CFO actually left Infineon. Yeah, and they left. The CFO left Infineon to join this company, and the CEO is like a veteran in the TCAD market, like the testing market, specifically in GaN market. For the last 40 years, he's written various papers. Whenever he goes on a conference, like analysts are just like enamored by him. He's had like multiple exits. I think the last exit was like a 10 or 12x in a matter of like 8 to 10 years. It was a much larger company as well. So the CEO is a rock star, and this is the only a company that's that has this product. And also they have been able to. They said that the second quarter will be the first quarter where they'll be GAAP profitable. So it's only inflecting. They have a licensing business which they're saying will double in revenue this year. And if GaN and SiC, if my thesis is right, and if 800 volt DC actually picks up, then this company will be, most people will be using their products because there's no competitors. This Synopsys, which has a small share, like both have equal share basically. It's a duopoly, and Synopsys is a very large market cap, so you can't really get exposure to this small segment. It's probably like 1 or 2% of the revenue, but for them this is everything they have. So it's more of like a high beta play that if it does play out, it's only 400 million market cap, and if the thesis goes from optics to this segment, this could potentially be like a nice little return. And yeah, just the CEO, the CFO. The CEO is a big selling point for me because he's written papers and everything else, and he's a veteran in this specific segment that he's done this for like almost 40-50 years, and he's very excited. He's like, I'm more excited about this one than I was for the last company. So this is like a high thrust sort of a play on the power segment, the power semi segment. So that's one that I would highly recommend people look into. The other one that that was more software. So it's a small portion of my portfolio, but I've been looking at this chart very closely, got in, out at all times. But I think finally it's looking like it's about to go higher, read it higher, and that's Reddit, everybody's favorite stock. I think it's starting to look like it's. I've lost. I've tried to like nail the bottom, and I've like lost on those. But as you said, like if that loses the level, I'm out, and then I can re-enter later. So I've been trying to like nail the entry to some extent, and like as we all know, like 60% revenue growth, 90% plus gross margins, gap profitable, buying back stock, just one company in that way. And if anybody doesn't know, 18 to 20% of all LLM inquiries used by almost all models come from Reddit. So 1 in 5 of answers that you see on your LLMs when you're putting in questions come from Reddit. And that revenue portion that they did, those deals are about to come up for renewal soon here. And I think that will be the next catalyst, because that revenue, I think, is only 5 to 10% of the revenue as of now. But that will materially change because they have had deals with them, with Google and everybody else. And the CEO recently said that they are working on deals where they're more like a partner and not a provider of data, and like not just API access. So what that means to me, at least, is basically there'll be some sort of a pay-per-use type of a model, and with like where like if the API from Reddit, or if Reddit is indexed in their searches, Reddit probably makes some sort of income from specific amount of times that it's indexed. And this is one of one in the sense that most of the licensing companies, there are smaller companies that just have data from the past. They're just selling their data, potentially leasing their data. But if Reddit can have a pay-per-use type of model, like that could really explode their income. That's probably going to be like all like bottom line creative as well. So that's the other thing about Reddit that I really like. And the other thing that I was going to also say about Reddit is they're increasing their products as well. So I think their search product is very crucial. And I personally, from my opinion, I think with people using LLMs more, less people are doing like blogs and stuff are probably becoming less what do you call it, like relevant, because people are not even going to blogs and stuff. They're just like having Gemini or like things like that to like summarize the call.
This is the major concern.
Yes.
Because,
okay.
Obviously, before you used to go to read comments and to read opinions and to search for information, and now this information is basically indexed and already fed into LLM. So I think this is the major concern. But for example, I mean, you have to also distinguish between knowledge and opinion, and I think this is really what matters, because it's just I was recently researching the company called Establishment Labs, and they're like they're making the silicone how's it called for
jackets,
the silicone implants.
Oh right.
Yes.
Okay.
Yes. And obviously I'm not an expert in this area, so I had to understand because it was stated that their product is something like an innovation that haven't happened for 20 years. But obviously I have no idea how true that is. So I went to the Reddit and just because you cannot ask LLM to go into Reddit.
Yes.
So I had to manually go into every thread and copy paste to LLM and ask to summarize. So while it was summarizing, basically it find one doctor's opinion who is an MD and doing this surgeries, and he said, yeah, this thing is for a very small use case, so it's not applicable to everyone, and it's a very niche product, and there are most of the things is like a marketing stuff, and obviously I could not know with Reddit.
Yes, 100%. Yeah, but I think those opinions, because they were saying that the CEO said that 40% of the queries that are queried on Reddit right now are basically are those opinionated things. Or what should I buy? What should I watch? What is how to parent and like things like these. And like that's probably the only place. I know there's like comments about like AI uh, responses and bots using Reddit and stuff like that. But I think with all that, I still feel like just the way the business is, if this was like, like a business that's not growing revenue, didn't have catalysts or things like that, I would be more wary. But like the balance sheet is pristine, income statement is pristine, there's a huge catalyst, and they are like Perplexity apparently also has 20% of their queries coming from Reddit, and they don't have a deal with Reddit, so Reddit is suing them. So I think there's probably a very high, like this is just a prediction. I think there's it's highly likely that once these all deals kind of go through, Reddit and Perplexity come to a deal agreement of some sort, and then Perplexity starts paying Reddit. So I think like I think this is probably going to become more important in today's day and age. With like just because there is no information is going to be impossible to scrape in terms of getting it from TikTok or Facebook or Instagram. It's probably hard to do. So Reddit is like it's a platform that's tailor made, I believe, for those queries to come in and have those opinions. If I like ask Gemini, what should I buy for this? These are my requirements. So and if they have access to all of the Reddit data, they can kind of go through, see all these opinions. Hey, these are what people are saying and stuff like that. So I'm actually, I think I'm biased towards that a little bit just because I use Reddit a lot. But just the way the balance sheet works and everything, the balance sheet is and everything else, I do believe that this is probably going to re-rate materially higher. And you get the
SBC,
software thematic. What's that, sorry?
SBC, stock
Yeah,
SBC.
SPC isn't that bad. It's not that bad. It's not.
No.
It's not that bad compared to like other. And the growing and the growing. It's growing pretty strongly as well. And like and that's if I was to get exposure to a software name, I would be exposed personally. I would rather prefer being long Reddit than ServiceNow or one of those stocks which Finex really loves. So that's why that's my so I want exposure to this because I've kind of seen there's been an inverse correlation between the market and the software names. So this kind of like helps the portfolio as well. And with the chart resetting, like, and the options that I bought were for February 2027. So for my calculation, I get exposure to almost 3 earnings calls. And if I'm right, then I should be able to do well on those options. So that's the other one that I would wanted to say. And the third one is your favorite sector, Take-Two Interactive for GTA. So that one, I got lucky with the entries there because last week was really good for me because I bought some leaps
I think
back
they
at
also
around.
entered stage 2.
Yes, that's right, exactly. So I bought some leaps at around 210, 215, right at the 100-day weekly moving average. And as per the call, Strauss Zelnick, the CEO, had mentioned that they will be buying back stock in around 180 to $200 level, and they've been doing that. And if you actually look at the chart, it put up a double bottom at around 188. So the buyback was active there as well. So and then he did 3 interviews, including the earnings call, where he said that it's coming out November 19th. It's coming out November 19th. And some of the analyst reports I was reading, they were basically saying that there was a delay still probably programmed in. So I had like made like a mental checklist of things how it's gonna work out and what would lead to these leaps getting re-rated. And the biggest one was that the first catalyst is going to be the overhang because the cash flow, as I say, certainty of cash flows, right? So that'll get moved, and that'll probably be the first catalyst for the stock to go higher. And then the other thing was I did a lot of research in terms of talking to my peers at my work. Almost all the boy like the men that work there from 18 years old to 40 years old are taking November half of November off basically to play this game. And then and,
Okay.
yeah, so I'm not even kidding. Like
Wow.
yeah, it's like November 19th to November 31st is like no one. Basically, a lot of the guys are taking that off to play this game. So I was like, and just the mental thing about this. And the other thing I'd say a few important pointers I'd point out because when I was, I guess I was when 15 or 16 when GTA 5 came out, and back then we couldn't get to play the game because back then the split between the people who bought the game on PSN or Xbox on the online versus the physical copies was about 90 to 10%. So 90% physical copies, 10% copies where you actually like buy them digitally, and we didn't have the credit cards and stuff like that. The penetration was very low, so people wouldn't be using credit cards that much. So we wouldn't buy the game at on PSN. But that has materially changed, not only for North America, but I think in Asia, this is a completely secular thing that a lot of the analysts probably don't get, because a lot of those physical copies didn't show up for us until like 6 months or something. So when I was reading the analyst estimates, they're saying 30 to 35 million copies for the first 6 weeks. From my analysis, I think that's materially like underrated. I think they're saying 60 million copies in the first year. I think that's probably accurate, but I think that moves up quite a bit. And then the other thing that is to be said is the online portion. So GTA Online still has been GTA 5 Online has been 15 to 20% of Take-Two's revenue over the last few years. So when GTA 6 comes online as well, which is also planned, which happened last time a month afterwards. So I think that's another portion where they can not only make money from the game sales, but if the game is actually really good, they'll make money on the shark cards and like the in-game currencies and stuff like that. So that was the other thing that I was kind of really interested in this talk. And I also noticed, so some people are actually getting back into GTA 5 now as well. As from our conversations at the office,
I
GTA
see
5
it
did launch.
in the subreddit, because the subreddit
Yeah,
started to grow.
yeah, that's right. So there's this heist. Apparently, there was two heists that were there before, and both the times it led to a lot of people coming in. And now they release another heist. And a guy at work told me that I need to like start practicing, because I want to be ready for when GTA 6 comes out. So I think the next quarter and like the quarter up to that would probably lead to like Q2 and Q3. Maybe Q2 maybe small because it's almost done, but Q3 there'll probably be a little bit of a bump from GTA 5 online. And then the cannibalization might happen in Q4, but it might be overstated as well, because the consoles are kind of expensive. Like PS5 prices have gone up because of the memory prices. So there might be people who might play just because of relevance, just because of social media, so much attention towards it. There's a possibility that GTA 5 online uplift also happens. If people have PCs, they won't be able to play the game right away. So there might be people who might just be playing GTA 5, and there might be some monetization from that as well. From whatever I've talked to multiple people who are gamers and everything, they're like, this is going to be the largest property to ever been created. And we've already gotten 2 upgrades this week. I think Burns it was like Piper Sandler went up to 300. There was another Bernstein maybe, I think went up to 280 or something. So they already started kind of increasing the price targets, and the pre-orders open on the 25th. So if the pre-orders do much better than what Wall Street expects, hopefully Take-Two announces something on Friday or the next weekend, and then we get another pop, the week after or something like that. So
But yep.
yes, yeah. So I
But
believe like the yes, sorry.
sorry.
I'll just say basically the biggest bear thesis right now on the stock, from what I've read from analyst reports, is the TAM for the number of devices that are out there. So when GTA 5 came out, there was a transition between there was a transition from PS3 to PS4, and Xbox was also launching their new console at that time. And at that time, the analysts were saying that there's 160 million PS3s. PS4s will also lead to an extra kick in game sales. I think from what I was reading, GTA 5 has sold 230 million copies. So they're saying that the number of devices that were available at GTA 5 were about 160 million devices at that time. Now with PS5 and Xbox One, I guess they have, I think, 130 million devices right now. So that they're saying the attach rate has to be incredibly high, and that's the reason why the estimates are low. But from what I've talked to a few people, people are actually buying the consoles. And the other thing also is, if you actually had a PS3, you probably were not on your first PS3, you probably had two or three. At least we had to, because our first device burnt out. So I had to buy the second one. So technically, there's a lot of people who actually had bought two devices, but that was all getting added into the 160 million by the analysts at that point. So it was not actually 160 active devices. It was just 160 devices were bought at that time. But PS5s, they don't really die down and stuff like that. And then at that time, there was this huge thing about PS3s as well, where you would put in your disc, it'll just have this orange light keep on going, and it will just die. And the same thing was going on with Xbox as well with their devices. So a lot of this device conversation, that attach rate has to be incredibly high to beat the numbers from past time, is actually, I think, is downright wrong. So it's not accurate. So the play for me is basically I've built a reasonable position. Really good time. Some of the calls are up like almost 40% already this week. So I'm going to take my money out, and then let those ride for the release of the online version, the release of the PC version when that news drops and stuff like that. So I bought the January 2028 calls. So still have a lot of time on that trade to like for it to play out, I guess. So
Where do they
yeah.
price the game?
They price it cheaper. They're pricing it at $70 USD.
70. Okay. So
Yeah.
let's say 100 million copies.
Yes.
Billions, 8 billion. They will 8 billion revenue, right?
Yes, yes. And the cost of development was about 2 billion. So if they do get 8 billion, that's like 6 billion. And market cap is 40 billion. So I think this will materially re-rate. And then there's also this revenue from, what do you call them? Um, the revenue from the online in-game currencies and stuff like that. So that could be another additional catalyst for the game. And it's not only like just I feel like it's just that this property is so big, and almost all the people that have never seen this before, because of the boys I was talking to at work, all of them are have either bought the stock last week or were buying the stock. So that's the other thing where it's like, I know again it's like a dumb thesis to some extent, but I think there's a lot of attention that's going to be on this game, and that will probably lead to a lot of retail jumping in to the stock as well. It's a $40 billion market cap, so I mean retail activity doesn't matter, I guess. But then as you said, stage two, so like a lot of momentum traders start to kick in, and there's a clear catalyst with that too. So it could lead to the stock price going higher. So that was the whole thesis for me.
Okay. Yeah, I'm just. I have no idea how now to value gaming stocks, because
Yes, fair
one of
enough.
the companies that I was also some time ago is Gravity. You know Gravity?
No, I have no idea.
It's like a Ragnarok
Oh, okay.
franchise, and it's basically traded below cash, I think, like forever. Then it's the stock spiked at once, but then it returns, and because there is a Japanese shareholder that is probably not very interested into, they just keep this cash on the balance sheet,
Yeah.
and I think a lot of gaming stocks are very volatile, sell the news when the game comes out,
Yes, comes out.
and a bit, yeah, I
I
give
do
up
agree.
on this sector.
I do agree. It's just like from my conversations, it's like I've kind of noticed that I could be in a good stock with good numbers and everything else, but it's just if no one is really interested in the stock, it won't re-rate. So, but with Take Two, there's like a clear catalyst of like
Yeah,
everybody kind of can jump in. You know what I mean? So like that's the only reason why I was like I'm gonna make an exception for Take Two, because like whoever I'm talking to, they're basically saying it's gonna be the greatest entertainment or biggest entertainment property ever created and stuff. So I'm like, this is like I've kind of talked about this in one of my videos, where it's like the stock market has like three curves. It's the mid curve, left curve, right curve. The mid curve is like the hardest to impress. The left curve and the right curve are the ones who make money, and it's pretty aligned in the sense that left curve and right curve are like, well, this thing is gonna
yeah, yeah.
do well,
I know what you mean.
and exactly. And the mid curve, I think, also can kind of jump in if the numbers actually do turn out to be good. So it's one of those where it's like it could become a consensus trade, and that's what you're trying to play. Where it's like, okay, if everything's gonna think is gonna go up, then maybe it goes, maybe it goes up. I know after all the intricacies that we've talked about, this is a pretty dumb thesis, but it has worked out so far. So we'll see how it goes from there.
Sometimes the dumbest thesis work much better than the smart one, so I agree.
Right. True.
Okay, I think let's wrap it up.
Yes.
I think thanks for your talks, for your pitches. I think let's see how it goes, and I really enjoy talking to you, because I learned from you. I learned from your ideas. That's why I also think that you should post also on the other stuff that you are buying and selling, because I mean we both come from this consumer angle and the social art, but I think we should you specifically should also inform more about your trades, and yeah. So
Okay.
that was it, I think. Thanks a lot for everyone who is watching it and specifically made it until the end. So thanks a
Yes.
lot, and see you in a month or so. I don't know. Let's see how it goes. And thanks a lot.
Take care, Dimitri. See you.
Bye bye.
Bye.